Okay, hello everyone. My name is Abby Adams-Prassel. I'm a professor in the economics department at Oxford, an associate head of department with a responsibility for external engagement and research impact. And welcome to this first of this What Economists Really Do series for this academic year. So these talks are really trying to showcase the breadth of what economics research has to offer and show you that it often goes into areas that you might not have previously expected. And so today we're completely delighted to be joined by Professor Hamish Low, the head of department at Oxford, who's going to be giving us some insights into the economics of disability, as much of Hamish's recent work has been on the design and workings of disability insurance and the broader social safety net. Now, in terms of a little bit of housekeeping, please type questions into the Q&A as we go. Hamish is going to talk for about 35 to 40 minutes, leaving us with enough time for Q&A at the end. So type your questions in there so I can start to kind of aggregate those. With that, thank you again, Hamish, for joining us, and over to you.
Thank you, Abby, and thank you for inviting me to give this talk. I think, just to reiterate what Abby said, I think it's really important that we're able to show a bit about, or one of the important things we do is to show a bit about what economics can really add to different sort of debates. So what I want to talk about is about the economics of disability. And let me just sort of kick off with a couple of starting thoughts. Okay, so where this starts from is it's a kind of an obvious thing to say, but health is clearly a key factor in living the life we want. And we think about how much we're able to enjoy our lives, how much we're able to enjoy our day-to-day living depends crucially on what our health is like. And I think in that sort of context, if we have these kind of changes to our health or severe changes to our health, they can have profound consequences to what our standard of living is and what our lives end up looking like. And the way to think about those changes in health, we can think about them as being essentially the small probability events, but they've got like a high cost and are often highly persistent. So I mean by shocks to health or changes to health, I mean issues such as the kind of physical health issues such as shocks to mobility through diabetes or through cancer, physical health issues which limit or affect how much people can go about their day-to-day living. And it also includes health shocks such as mental health issues, such as distress or depression. Now, those changes in your health as you go through your life, they have these profound consequences. And the question I really want to kind of focus on, I think economics has really got to address here, is how to ensure that individuals have enough resources after these changes happen. So something happens to you, an individual is diagnosed with cancer, that it makes a big difference to what they're able to do with their life. But what we can think of as economists is, well, how well insured are they? How well are they able to deal with those sorts of shocks and to try to mitigate the costs? And I think today I want to focus on a very particular sort of set of issues here. There's a huge range of issues around disability, and there's a number of things I'm not going to talk about. If I'd been given 3 hours, I could have talked about all these other things, but I've got 40 minutes. I thought I'd just focus in on a particular set of issues. And that set of issues is about conditions or health shocks that start during adult life, and particular shocks that impact an individual's ability to support themselves through work. So there are, I think, really crucial issues about children who have got disabilities and are unable to look after themselves going forward. And there's also issues about what happens towards the end of life in terms of people's health. I want to focus more narrowly than that on what happens in that kind of working life, because that's this period of people's lives where we expect them to be independent. And so it's really about how does health impact that ability of individuals to be independent. So I thought I'd just start by giving a little bit of data. I'm going to use data from the US and UK through this talk. There's clearly data from a whole range of different countries. This is just to try to keep it so manageable. So what I'm going to show you here, just to kind of kick things off, is a little bit about how prevalent these disabilities are. So these are prevalence of things which are health shocks that stop individuals being able to work. And I want to draw attention to a couple of points. So the first graph, this graph here, is showing the fractions of the population who have a moderate disability. And you can see on the x-axis, we've got age. On the y-axis, we've got just the fractions. And again, the blue lines here are showing for the low educated group and the red lines for the high educated group. And there's really, I think, 3 points to draw from this. And you can see over here on the right-hand side, this is for severe disabilities. First point to draw is not surprisingly, the steep gradient of what happens through people's lives. You know, the prevalence at age 25 of those shocks is pretty low. By the time you get to 55 or 60, you can see that prevalence is way higher. This is up to about 10% or 15%. Second point is I think about the level of the prevalence. For the low educated group, age 60, you've got about 15% of the population are reporting moderate disabilities, and close to or 18% of the population are reporting severe disabilities. So by age 60, you're seeing these very big fractions of the population who these sorts of shocks have impacted on. The third thing I want to kind of stress here is the difference by education group. So you can see that at all ages, the low education group, the prevalence of disabilities is greater among the low education group. Now, I'm not going to talk about why that may be, in part because I don't think we know why we've got such a big education difference. But it is something which is going to kind of impact on how we think about protecting individuals and who we should be protecting when these shocks happen. But again, the takeaways I want to take from this are the level of the disability, the prevalence being pretty high, the increase happening over time, and again, the difference between the education groups. If I move on now and think about, well, how effectively are individuals insured against those sorts of health shocks? The first point, which is a sort of, I think, a fairly obvious point, is it's very hard for individuals to insure themselves. So it's easy enough to insure ourselves against events such as a small shock like not having any income on any particular day. It's easy to smooth that out over time. But health shocks, an example where you've got cancer, for instance, which has affected your mobility, it's a low probability event, but it's highly persistent. And I think those two characteristics of these shocks are what make it so hard for individuals to insure themselves. It's the fact it's a low probability of it happening, but it's a very persistent and serious impact if it does happen. Similarly, there's a market failure here. And market failures are arising because we've got individuals who've got private information about health. And that private information means the ones who want to take out insurance are more likely to be the ones who need the insurance. And so it's got an adverse selection problem, which is going to mean the market ends up being inefficient. And the second market failure is about the kind of unobserved effort at looking after health, so we don't observe how much effort people put in. If the market's offering insurance, you can see that ends up or may end up impacting on how people are looking after themselves. Now, there's a natural economics question is to think about how important those two aspects are, which generate the market failure. What I want to do more than that today is I want to think about this market failure, take them as given, and I want to think about what that then implies about the role of government. So in particular, we could ask the question, how well is the risk insured by government? So individuals cannot insure themselves. There's no real market for long-term care, long-term provision. And so the question is, what's the government able to do? And the way to think about that question is in one of these three ways. Actually, these are all different ways of asking the same question. The one is we can think, how do we provide insurance to those who actually need the insurance, given there's a certain amount of revenue available? And given, so how do we provide that insurance to those who need it? Given there's a difficulty of knowing who needs help, which is back to the private information problem. This difficulty of knowing who needs help is because individuals have private information about their own health. And thirdly, it's you provide that insurance to those who need it, given it's going to impact decisions on whether or not people work and also whether or not they invest in health. So when we're thinking about how well the risk is insured by the government, we want to think both about what's the extent of the insurance, is the insurance reaching those people in need, and how is it dealing with that insurance given these incentive costs through providing insurance, providing the benefits to perhaps the wrong people and impacting on their decisions to work. So that's the kind of broad context of where we're at. I want to do four things in this talk, and I want to cover. I mean, pretty quick going through them. First thing I want to do is I want to give a bit of background given we're thinking this question about how well is the government providing insurance, then the first thing to show you is a little bit about what the nature of disability support is that's provided by government. And start off by doing that. Then I want to talk about what the incentive effects are and how, as economists, we think about those incentive effects. Third thing I want to talk about is the screening errors, which essentially is the insurance that's being provided, is it reaching the right people? And the final thing I want to conclude with is just thinking about the trade-offs. Because in some sense, what economics can add here is about thinking about these trade-offs between making sure we provide the insurance to people that need it against the incentive cost. And I think one way of characterizing a lot of the public debate that we see, and actually a chunk of the work done in economics, in my own work, what I find is we spend too much time thinking about the incentive costs and too much concern about those incentive costs. And what that's meant is we've reduced the insurance value that's provided through the program. So that's the kind of theme I want to be bringing out through this talk, which is we've got ways of thinking about incentives and of the kind of errors, but we've got to trade off those incentive costs against whether or not we're actually providing insurance to those people that need it. And the key lesson I want you to take away is, if we read particular the coverage which happens in newspapers and is very much focused in on that incentive issue about false claimants and people who shouldn't be receiving benefits. Okay, but I'm going to come back to that in a little bit. I want to start by kicking off talking about just the levels or sorts of disability support which exist. In particular, I want to distinguish between two sources of support. Now, the support I'm going to talk about there's two sources. One is what I'm going to call disability insurance, and the other is disability benefits. So disability insurance is called insurance because it's about replacing lost earnings. So in the UK, that's it was the employment support allowance. In fact, it's gone through a whole set of different names over the last 30, 40 years. I'm going to refer to it as the employment support allowance. It's now wrapped up with universal credit. But essentially, it's about giving people income to replace the lost earnings, where those lost earnings have arisen because of a health shock. Now, there's a distinction here. I think this kind of helps think about the way in which insurance is thought in government circles. There's a distinction between when someone's applying for disability insurance, whether they go into a group of people who are, in some sense, they're then helped to prepare for work. So they believe they've still got some work capability. That's one group. And the second group is a group of people who are assessed as having limited capability and they're not going to be able to work, and they class as a support group, and they actually end up with more generous support. But the point is really about this disability insurance is that it's about replacing lost earnings. And the contrast from that is when you've got disability benefits. And disability benefits are not about replacing earnings. They're about dealing with the needs that have arisen because of the health or the medical needs. So there are issues such as mobility, needing extra help around the house, help moving, help cooking. These are the sorts of issues which generate disability benefits, which then come through personal independence payments. Now, what's crucial when we're thinking about this is that those benefits are dependent only on need and are independent of any work or search requirements. So that's the kind of contrast I'm going to talk about a little bit as we go through. The other issues about source of support are about, well, are there partial payments? In the Netherlands, for instance, individuals can receive disability insurance that covers them for, say, 2 days a week, as opposed to for a whole week. Whereas in countries like the UK and the US, it's essentially it's full-time replacement or nothing. Okay, so that's the kind of notion of disability support. Let me show you some graphs and show you how prevalent this is. And when I first saw these, I was like pretty stunned by the extent of the problem, or extent of the support being provided rather than extent of the problem. The problem we saw previously by seeing the prevalence. This is now about what fractions receive the support. So the left-hand graph is the US, right-hand graph is the UK. And what this is showing the 40-year trend in the fractions of individuals who are receiving disability insurance. See, in the US, it's gone from 2% of the population up to about 4.5%. Now, and I'm going to talk about COVID in a minute, but that trend upwards means that in the US at the moment, or pre-COVID certainly, the number of people on disability insurance was substantially greater than the number of people receiving unemployment insurance. And if we look then at the UK, here I'm drawing the distinction between disability insurance and disability benefits. And I want to again focus on the level of what's happening to start with. In 1980, it was about 3% of people on disability insurance. That's gone up substantially to over 7% by 2000. And then it's declined. And it's particularly declined as progress has got more strict in terms of that insurance eligibility. What's happened at the same time, you can see by the dashed line, is an increase in payments which I'm calling disability benefits. And those are payments which are directly targeting the disability need. So what's happened is in the UK, there's been a movement away from a scheme which is aimed at insurance, about replacing lost earnings, directly at a scheme which is more at the additional needs that people need when they are when they have these health shocks. Okay. If I think then about how that translates into spending, just to give again an idea about how important this is. In the US now, this is the left-hand graph, the US, the right-hand graph is the UK. In the US, we're about 1% of GDP is being spent on disability benefits in total. So the solid line is disability payments in total. The dashed line is unemployment insurance. So you can see about 1% is going on disability insurance in the US. It's a bit less in the UK, it's about 0.8%, but it's still pretty substantial. The contrast with unemployment insurance is pretty striking. So the amount we spend on unemployment insurance is way less than what we're spending on disability insurance. It peaks up when we're in recession. Look at this, at the start of the 1980s recession. Unemployment insurance went up massively when unemployment was over 3 million. But essentially, what we spend on unemployment insurance is trivial compared to what we're spending on disability insurance. And the reason I'm making that point is because it ties in with what we had in the previous graph. We've got a large fraction of the population in the UK, about 7%, 8% of the population, who are receiving disability insurance of some form. We're spending about 1% of GDP. So it's pretty important for us as economists to think about the questions, are we actually reaching the right people? And what are the costs for the economy of providing this sort of insurance? Now, actually, I'm just maybe just one quick comment on this. This is just about the definition of what disability means, to give some notion of why this is not just being sick for a short period of time. This is what needs to happen to kick in getting benefits. Essentially, it needs to be an inability to engage in any substantial work. It needs to be due to a medical problem, which are either physical or mental, and it's got to be expected to last for at least 12 months. So those are the criteria which are being applied to see if we've got a need for disability insurance. Now, the last thing I want to do on disability support is just to put in one impact of what happened to COVID. Maybe we can come back to this later. So the impact of COVID has been pretty substantial. I'm going to come back to this later, but the impact of COVID was pretty substantial in the sense, think about a number where we had 7% of people on disability insurance before COVID. Additional 3% of the working age population had long COVID by mid-2022. So if you think about that's a kind of a big increase in the fraction who are actually going to need or be applying for claims. And you can see that's exactly what happened. It was a doubling of claims through COVID. It's fallen back to just about a 50% increase compared to pre-COVID now. But that's translated into a 25% increase in spending. So COVID had this big impact on the amount of disability insurance and disability benefits that are being paid out in the UK. And I just want to kind of mention that there was this reform in September 2023, just last month, or proposed reform by the government, to increase or to change the way disability benefits are being paid. And what the shift was, it was a shift towards requiring more work preparation. So that's more people who are saying, actually, although you're receiving disability insurance, you should be preparing for work. So the shift in reform is essentially about trying to move individuals more to being a shorter term on disability insurance as they're able to move into work. So let me move on now and think a little bit about incentives. So the issues we're going to talk about, as I said, we're going to have these incentives to work. We're going to have this question about targeting of programs as the screening errors, and then we'll talk about those trade-offs. So let me start by thinking about the incentives. So the first thing we thought about incentives, we may think about how does the provision of disability insurance affect labor supply? So does disability insurance change how much people work? Now, this is a kind of classic incentive problem. We're worried that welfare benefits reduce a labor supply. One way of doing this would be to look at what the correlation is between how many hours that people are working and their receipt of disability insurance. So if I look at that correlation, what I see is there's a large negative correlation. Individuals who have got disability insurance are correlated with them working many fewer hours. Now, the point I want to kind of stress is this is bad econometrics. So looking at this correlation, just a straight correlation, is bad econometrics precisely because we need to ask the question, who are those who receive disability insurance? Those who receive disability insurance are going to be individuals who are in the poorest health and the least able to work. In particular, they're unlikely to be working even if there was no disability insurance. So why does that matter here for our thinking about assessing incentives? Well, it's this classic econometric problem of we're missing a key explanatory variable. So here, if we're looking at this correlation between the hours of work and receipt of disability insurance, what we'll be missing is the unobserved level of health. And that level of health is explaining both why someone receives disability and explains why they are not working very many hours. So we have to be really careful thinking about understanding the incentive effects and thinking about have we actually controlled properly for people's underlying health. So the way we get at that, just to give a couple of kind of thoughts on this, one way we get at that is we ask the question, how many disability insurance recipients would be working if there was no program? And the estimates we have is about 30% would have been working. And there was 2 points I want to make. One is about 30% would have been working, which that compares to a working age population average of about 90% of individuals are working. So 30% would have been working if the program wasn't there. There's going to be an impact on rejected applicants, though, which is the very nature of disability insurance may lead to skills of depreciation. But the point I want to stress is that 30% would have been working is going to be very kind of heterogeneous according to how severe the work limitation is. And even the 30% itself is not a very, very high number. Let me just show you that in a picture. So this is a picture where the decision about disability insurance is taken at time 0. And this is essentially the fraction of people who are working. And you can see, if I just concentrate on comparing the dark blue line here with the diagonals, which is the individuals who are awarded disability insurance straight away, with the black line here with the crosses, which are those who are not awarded disability insurance. What we can see is that in the run-up to be applying for disability insurance and the decision being taken, we see that both sets of individuals are exiting the labour force. So we see a decline in how much people are working. We see that when people are actually awarded disability insurance, we end up with them, there's a small fraction who are working a little bit, but essentially they are not working hardly at all. The individuals who've been denied, the black line here with the crosses, those are individuals where they are, they're said that they're actually able to work. And the question is, how much are they actually working? Well, here, they're working about sort of 50%. And if we look at the individuals who were rejected and then they appealed and they were still turned out, they're only working about 35%. So what I want to take from this is, although we end up with these disincentive effects from the program, it's not that being rejected by the program means that these individuals here are back to working at how they were working before. There is something which has happened, which has actually caused consequences for their incentives. Okay, so let me, I've said that already, I'm going to skip on that. So what's the takeaway I want to take? Well, the first takeaway I want to take from the thing about incentives is that labour market participation for the group of applicants is very low. So when we think about incentive costs, we're talking about incentive costs on a group of individuals who have got reasons why they're exiting the labour force, who've got reasons why their participation is very low. So we're talking about incentive costs, but for a very low base in terms of how much people are working. Second question, or the question this raises, is how can the government provide insurance to those in need without damaging these incentives, and essentially how well it can target insurance of those who need it. So that's why I want to turn to thinking about the screening errors. Now, screening errors, what I mean by that, to try and be a bit precise, this is when an individual's applied for insurance. So an individual's decided that their health is such that they're no longer able to work, and they're applying for insurance. And there's two sorts of errors which the government can make at this point. So one is, the question is, are some who need, are some individuals who need the support actually, are some individuals who need the support being rejected by the system? So I've got an extra word in there. Are some individuals who need the support, are they rejected by the system? Now, I call this false rejections because they're people who are in need who are turned down. And if they're in need and turned down, that's a kind of failure of the insurance, and that's a kind of false rejection. The other sort of screening error is, do some individuals who don't need support still receive it? And that's a question about, are there these false acceptances? So are there individuals who've applied despite them not actually really needing it, and are they actually still receiving it? Now you can see how this is couching in terms of the debate we see in the popular press in particular, is a lot of the focus there is on these false acceptances. People who are receiving the benefits but shouldn't actually need it. They should be back working, but they're getting insurance instead. There's very little discussion about the false rejections, the individuals who should be receiving support but are rejected by the system. So what I want to do is I want to give you a bit of evidence on how important these false rejections are. And I also want to show you a bit of evidence on how these errors differ by gender. And I want to do that because if we're thinking about protected characteristics, we're thinking about issues of equality and inclusion, there's a lot of these kind of intersections going on between different characteristics. And here I want to show you a little bit about how that intersection between gender and disability affects how much insurance is provided by to different people. So this is just to give a little bit about what's actually happening here in terms of where people have been denied. And I'm putting this in because it gives a sense of the range of illnesses that people are applying for disability insurance for. And you can see at the top here, we've got people applying when they've got cancer, there's digestive problems, neurological problems, breathing. And then down here, we've got mental disorders, stress, depression, musculoskeletal, in particular back pain. And on the x-axis here, we're just talking about the fractions who are denied when they apply. So you can see if you apply for disability insurance, this is US data, but it's similar to the UK, we just don't have the same disaggregation. In the US, we see people who've got back pain problems or they've got mental health problems, they're rejected at about 65% of the time. With individuals who've got cancer or digestive problems, the rejection rates are about 30%. So we do see big differences in the level of insurance that's provided to different sorts of problems. And one way of thinking about this is thinking, well, essentially the problems at the top here with the lowest denial rates, the health shocks there, they're health shocks which are more verifiable. As we get further down, we see these health shocks are less verifiable. And as they become less verifiable, it becomes more open to concerns about the incentives, the wrong people getting the benefits on the one hand, but also it raises the issue about, are we actually getting the targeting at people who really need it? Because clearly back pain and mental health problems are substantial debilitating factors. I'm going to skip that. I'm just going to skip now to show you a bit about how this differs by gender. So what we've done here, or what I've done here in this picture, is I've just characterized different conditions into three different groups, roughly by the kind of how verifiable they are. And you can think about on the left-hand side here, we've got and this is the type 1 error. So the type 1 error is the false rejection. It's the fraction of individuals who apply who should be awarded the benefits who get turned down. So here, and the blue is the men and the red is for women. So if I take this first column here as being about people who've got cancer, I think for men who've got cancer and they genuinely need insurance, we see a rejection rate of less than 20%. We can see how that increases that rejection rate. If we look at cardiovascular heart disease related problems, that goes up to about 45%. And we see it's actually pretty similar when we look at mental health, musculoskeletal problems, it's around about over 40%. So those are the rejection rates for men when men are genuinely in need of insurance. If I look now at the red bars are what are the rejection rates for women who've got the same health conditions. Now, when we first saw this, in some sense, this is to me, this is a completely shocking picture because it shows if I condition on two individuals, one of whom is a man and one of whom is a woman, two individuals who've both got the same health condition, say they've both got cancer, we see there's a 25 percentage point difference in their probability of being falsely rejected. And we see that probability exists not just for cancer, it exists where there's kind of heart-related problems, and it exists when we're looking at mental health and back pain-related problems. So what's happening is, we see is, first of all, well, 2 points I want to stress from this. First point is the level of these false rejections. The level of the false rejections, both for men and women, says that a lot of individuals who need support are not getting support. The second aspect of this is the shocking aspect to me, which is that there is this big difference by gender in terms of who's actually receiving the support which is needed. And to stress, this is among individuals who are independently assessed as actually needing the support, and then they're being turned down by the administration. Again, what I would say about this is, notice this is for US data. It's done for the US because we cannot do the same thing in the UK. And I think this is a real push to say, as economists, what we're restricted by is what data we have access to. And these questions, to me, are first-order, crucial questions for us to address. And we cannot answer them in the UK because we don't have access to the data in the same way. Okay, the last thing I want to kind of say on this is just understanding why these rejections take place. What I want to do is basically, just in terms of one numbers, what's the reason for rejection? And people could be rejected either because their health is assessed as actually being there in good health, or they can be rejected because they're assessed as being capable of working despite their health condition. And we look at why there's a reason for rejection. And basically, there's no difference between a men and women. That's what the stars indicate significance. Excuse me. There's no difference between men and women in the health assessment. So the men and women are both equally assessed as having cancer, which is a serious illness which is going to have an impact on their work. The difference is that women are judged to still have capability of working. So women are rejected not because they've got they're not believed to having a health condition, but because it's assumed that it's assessed that their health condition leaves them with this capability of working. Question is, how is this decision reached? Now, this decision is reached, or part of it is reached, because of the sort of questions which are being asked by, this is the US administration. They're asked about, in particular, look at question 7, I hope you can read this. Question 7 says, do you take care of anyone else, such as a wife or husband, children, grandchildren, parents, friends, or others? If yes, who do you care for, and so on? And this is asked of anyone who's applying. Do you take care of pets or other animals? Do you help other people? Do you do the shopping? And how do you do it? The reason why I'm putting this up here is because these questions are used to assess residual capacity for work, both of men and women. But you look at these questions and think, well, there's a lot of gender norms in society, and those gender norms in society may lead to differences in answers to these questions for people, for men and women who've got the same residual capacity. But what's happening is those questions are then being used to judge capacity. So someone who is doing more of these activities through necessity ends up being assessed as being capable for work and then gets rejected. So in a way, what I want to take from that is thinking, well, we do have this rejection taking place of individuals who are in need of care or in need of support. But those rejections taking place are particularly bad for women compared to men, and they do actually, part of those are stemming from these sorts of questions which are being asked. So just to summarize where that's at, and then I want to just, in my last couple of minutes, turn to the trade-offs. So just to summarize where that's at, we do these substantial false rejections happening. Those rejections are larger for women than they are for men, and it looks like this is about women being able to find other work. I think this differences really matter. They matter because we know that rejected women who have these work limitations don't actually work. So it looks like this is kind of their capacity is being overestimated, and then this has these big welfare consequences. Just one policy implication on this to think about that gender difference. A natural kind of consequence of this is people would ask questions, well, why don't we use machine learning? Why don't we use hand the decision-making over to computers? And I want to kind of stress at this point why that's such a problematic thing to do in this context. It's problematic for two reasons. One, because the machine learning algorithms are going to have to learn the responses based on underlying decisions which have been made by the administration. So in some ways, the algorithm is going to build in bias. That's a kind of standard problem with machine learning. There's an even bigger problem in this case, because a lot of illnesses end up being gender specific. And so you can end up with what looks like and having no bias because it's a gender-specific sorts of cancer. But those gender-specific biases can still be, will then be amplified by this kind of machine learning algorithm. Okay. Right, let me just, in my last kind of 2 minutes, just talk then about these trade-offs that are going on. Because in a sense, we've got a pattern here where we can see there are these incentive effects of providing this insurance. And we can think about how large they are or not. And we can see there are these screening errors going on. So in some ways, we want to ask the question, how do these trade-offs play out? Now, to ask these trade-offs, we have to have some way of evaluating the insurances provided by the program. And I think the best way of evaluating that insurance is by looking at what the extent of consumption losses are, because that gives us a measure about how much people's standard of living falls when they have a disability shock. And then we can ask how much that consumption fall is mitigated or offset by the provision of the disability insurance. So we're going to consider reforms that trade off insurance against those incentives. And there's a whole lot of work in the background that does this. The kind of conclusion which I want you to take from this, and then we talk about the reforms, the conclusion is there's actually an insurance failure. The insurance failure because we're not getting enough of the insurance reaching people who are in need, and there's too much focus on the incentives. So that then tells us or helps us think about what direction of reforms we should be moving in. And I want to give some nature of those reforms about what the trade-offs might be. So I want to just consider two reforms I'm going to talk about. One is we're making payments more generous or less generous. And the second is being tougher or less strict on the health criterion by which people are admitted. There's other things we can consider, but those are the only two I want to show. And I just want to show you two pictures. So this is one picture. This is just using this is simulating a model to see what happens as we change the generosity of the program. So on the x-axis, a number above 1 means generosity goes up, below 1 means the generosity decreases. And I want to just focus on two lines. The top line here, the black dashed line, is the fraction of individuals who were aged over 45 who were getting insurance. And the blue line here is the number of false applicants. So it's the number of people who would apply for the benefits if the generosity was larger. Now, what's important about this is that as we increase the generosity, we do see this increase in the number of false applications going on. And we don't see much of an increase in the number of people who are insured. And this is exactly why we think, well, there is an incentive cost of increasing generosity. But what the increased generosity is doing is, although the number of people who receive insurance who need it hasn't gone up much, those who do get that insurance are getting more insurance and getting more payments. And so if we do the calculation on this, this is an increase in overall welfare. And it's an increase in overall welfare because the group here who are getting the extra payments are those who really need it, and their value of money is very high. So we end up increasing generosity. It has this price to pay in terms of false applications, but it's got this benefit in terms of increasing the welfare of individuals who are most in need. The other reform we talked about, or I mentioned, was the increase in the strictness of the assessment. Again, the dashed line, the solid line here, the vertical line, is where we estimate the strictness to be. So we can imagine increase in strictness going to a higher number, or decrease in strictness going to a lower number. And again, I want to just focus on the black dashed line, which is the fraction who get the insurance. And the blue line here is the false applications. So as we increase this threshold, and make it harder for people to cross that the test of receiving disability, what we see is the number of false applications falls off. You end up with a program which is much better targeted at individuals who need it because you don't have that incentive cost. You don't have individuals who don't need the benefits going onto it because they get rejected. But the price you get for that is what we see happening to the black dashed line. The price we see is that as we increase the strictness, we see this fall off in the number of people who really need the insurance being turned down, or sorry, being accepted. So the number of people who are turned down goes up. So though we managed to deal with the incentive problem, it's actually got a big cost to it, which is there's much worse insurance provided to those who are in need. And again, we can do calculations here about thinking about welfare, and the conclusion we get to is that this incentive cost of stopping individuals who don't need it getting it is too high a price to pay when we think about the implications for those who do need the insurance. So let me just kind of wrap up with just summarizing what I want to take from this, what I think economics has got to contribute. So the first point is this point that disability health shocks, they're persistent shocks and they're large. And so they've got these big implications for people's lives. And there's a role for government in providing insurance for those individuals who cannot work. It's got this impact on the incentive to work, and there are also errors in the disability insurance decision process. And it generates but those errors are generating substantial false rejections. And the other point there is just these differences between men and women. But the real thing I want you to take away from this is this focus on incentives. It misses the importance for those who need support. It means we're focusing on stopping individuals gaming the system or inappropriately getting the benefits, rather than thinking about how viable it is to those who need it. And if I think about the role of economics here, what the role of economics is it can assess that trade-off. It can use models of behavior and estimates of actual behavior to see where that trade-off lies. And that's my kind of key conclusion. We can use economics here, which will help us with that understand the importance for those who need support. Thank you.
Thank you so much, Hamish. That was really fascinating. I thought, well, actually on a number of dimensions, some of the statistics that came out, both in terms of like the prevalence of different kind of disabilities in the population, the size of the false rejection rates and the differences by gender was also huge. And I thought it was also kind of an interesting caution, sorry, I've got a cold, cautionary tale in terms of sometimes economics can, be kind of summarized under the mantra of incentives matter. But actually, there's not in all contexts to the same degree, I guess, is one way of thinking about your conclusion. So we've got a couple of questions coming out. And okay, so one which I sort of guess relates to this idea about actually how important are incentives, and also some of the frictions and distortions that you were mentioning in terms of people not applying perhaps who should be. How do you think about the role of kind of providing universal coverage? So rather than having disability insurance versus unemployment insurance versus kind of other forms of social assistance program, Avantika asks, would just simply providing universal coverage be a better way of setting up our systems?
Interesting. No, that's a good question. So this relates to the kind of universal basic income idea, and I think it's really important to distinguish between rolling disability insurance into the other forms of provision like housing benefit and income support and so on, which is what's happened with universal credit, where there's now a unified way of thinking about providing benefits. That's one thing. But I think what you're asking is slightly different. You're asking this question about, should we be saying that everyone in the population should be receiving a particular form of a level of payment, and that level of payment is then independent of things like disability and so on? I think the reason why I don't think that's going to work in this context is because if everyone in the population is receiving a level of benefits which are enough to help individuals who've got disability problems or disability shocks, help them live a life which we want to live, then the level of benefits is going to be so high that it's going to be too costly. And I think that's where, when I was phrasing the question about how much insurance should we be providing, is given we've got a certain amount of money to spend. If we did not have a constrained amount of money, then I think what you're asking is exactly right, because what you're asking is going to say, well, we can remove the incentives by just giving people the money without making it conditional. The issue there is that we can't give people enough money to deal with the loss of their living standards that's happened through their disability, the disability shock. So I think in disability in particular, I think universal basic income is not going to work. I can see exactly because the consumption needs are way greater for people who are not able to support themselves.
It's interesting because the other part of the question that they asked was, how might this kind of transfer into a developing country context? And I guess there, where you think about kind of the budget constraint at the kind of government level perhaps being even more binding, I guess it sounds like what you're saying actually is that might be even more true in a developing country context. There's
another related question, particularly thing about developing countries, which is, how do we evaluate investing in disability insurance versus investing in the health system? And it feels like they're both necessary, but it feels like a health system which is preventing illnesses, preventing substantial illnesses early on in life, or helping development through childhood, is going to help offset a lot of the cost of disability insurance, because you end up with individuals who are actually able to provide for themselves in greater extents. So I think that trade-off is a really stark one. And actually, it's a stark one in developed countries as well, where we've still got these trade-offs to face. But that's the way I would think about it. You've got a budget constraint, and then we're thinking about, do we want to spend the money on health provision improving versus disability insurance for improving? I think the first order issue there is probably with health, and particularly health of children.
It's really interesting. So Serena is asking, so one of the first graphs that you showed was about the prevalence of these moderate and serious kind of disabilities with age, but as well as you noted, like there were big differences across education groups. And they were just asking, is like education here simply a proxy for income? Can you provide any insights into what might be behind that gap?
So education is partly a proxy for income, for sure, in that people who are higher educated have got more income than people low educated. I think there's a couple of other things which are less clear cut. One is about occupation. So we can look at within occupation by education group, we still see a bit of a difference, but not near the same extent of difference. So I think part of what's happening is people are ending up in different sorts of occupations, and those have got different health consequences. That's part of it. I think the other thing is, which I haven't looked at much, we looked at it a little bit, is about an intergenerational component. So there's a component which is about your health as a function of what happened to you in your childhood. And that's got a very much intergenerational component, which may be captured through the education channel. So what we've been trying to think about is ways of getting at that by looking at the health of parents to the health of children, and think about, again, whether that's a linkage which comes in. What my real answer to this is, I don't want to say anything definitive about why that comes about, because I don't think we know. I don't think we really know about different channels like information. Is it about easier lives? Is it about income? Is it about intergenerational transfers? There's a whole range of things. And I think it's an open question. I think it's a super interesting question, but it's an open question.
Maybe a bit of a call for DWP to open up some of their data in the same way that you were able to in the US. And okay, so actually going back to that research of yours that you were mentioning about this gender bias in disability assessments, a couple of questions asking, can you maybe just give like a couple of sentences on like kind of how you did that and worked out these kind of like the wrong, if you like, rejection rates? And is there anything that you can that you've thought of about steps to counter that gender bias?
Okay. So on how we did it, so we had, so in the US as in the UK, the Social Security Administration, or DWP, they've got clearly the records of what individuals say is wrong with them, and what is judged to be wrong with them by the administration. What we have in the US is we've linked that data to survey data, which is independent. And that survey data asks people about what their daily living is like, asks them about what activities they can carry out, asks them about their health, hospital visits, and so on, in a way which is independent of what's reported to the administration. So our assumption is that the data which is provided in that survey, and it's kind of fairly, and it is robustly checked and so on, the data provided in that survey, is a survey that's been going on for the last 30 years. The data in that survey is a reliable indicator of people's true health. And then we can compare that to what's in the in Social Security Administration data. And that's the way we can tell people who have got true health problem are then being rejected by the administration. And I think in the context of verifying why we think this is true or why this is valid, it was two bits. One is, we see people who say they're not able to work, who get rejected, they end up not working. Yeah. So the people who end up with a health shock, they say they had a health shock, they say they're not able to work, they tell the administration, they get rejected, but they're not able to work. We don't see them going back to work. So I think that's a kind of pretty a crucial aspect to us of why this is kind of reliable. The other aspect is that we see people over time, their lives don't get any better. We don't see, it's not like this is a transitory thing, it's a long-term effect that they're not getting support for. In terms of how we would counteract the bias, again, this is a really tricky question. And I think one way of thinking about this is, I think when we're asking questions about activities of daily living, we have to put them into a cultural and gendered context that they're being asked. It cannot be we ask individuals, who does the shopping in your house? Who looks after the children in your house? And takes that as evidence of what else could be done. Who does the cleaning in your house? And then it's not totally surprising we've seen differences in gender by those answers. I mean, one way of, if I was categorizing, say, if you are a layabout husband who does absolutely nothing around the house, you then, in that sense, you've got more chance of getting disability insurance because you can say you're not doing any of these activities. And that feels to me that what's going wrong is it's conflating people's capabilities with their decisions.
Yeah.
And we're using decisions that people have made as an indication of their capabilities. And I think that's at the heart of where some of these decisions, or where these things have gone wrong.
That sort of relates a little to Sean's question, who is asking about like how the lived experience of people with disabilities is taken into account in your analysis. And it sounds like kind of some of the survey data that you're describing asks a lot more for a lot more information about how people are living their lives. But are there any other measures that you kind of think other economists are taking to ensure that that lived experience is kind of reflected?
So I think it's a really important question about what's the lived experience. And I think, so I'll talk in a second about the ways in which we can measure what happens to people's lives. At a more accurate level, for an individual, you can ask questions about how they feel about their lives. And I think what's interesting about those results, and this is why I think in some sense understanding lived experience is pretty crucial, because you look at what people say about how they feel about their lives after these health shocks happen. You actually see quite remarkable recovery in people's adapting to how they feel about their lives. And so you see, if you're kind of like satisfaction, where you do see this big drop off when these shocks happen, but then you do see a recovery in how people feel about their lives. I think what that misses is what the realities of what their lives look like. And then we see, in some sense, what's remarkable is the recovery that happens, despite we see in the data issues like, well, actually, I cannot walk upstairs. I cannot get to the shop. I need help doing these different things. So we do have some data on those kind of lived experience. It's one of the things where I don't think we do understand enough about. And I think that's partly because there's a kind of limit to how far quantitative data can go in terms of really understanding what that lived experience looks like. And I think that's where, in some sense, where I think in terms of economics, we should not be thinking this is just an economic issue. We should be partnering with sociologists, we should be partnering with people, health professionals, and trying to get the overall picture of what lives look like and what support is needed and what insurance should be provided.
Great. The question from James about the role of the private, like kind of just talking a little bit more about what the role of the private sector could be, because you kind of started the talk by talking about market failures, but they asked about, is there a way to incentivize the private sector to provide disability insurance in a way that's more similar to traditional insurance? I think it's quite an important question. So I was just wondering, yeah, maybe you could give a couple of thoughts on that.
So I think the first thing I'd say is that the kind of underlying information problems which the private sector faces, the public sector also faces. I mean, it's not that doing this in the public sector solves the problem of the private information about people's health or the kind of moral hazard, the kind of private actions people are taking. And you can see the problems the government's got are just manifestations of exactly the same issue about that private information. The bigger question is about why is the private sector able to provide health insurance? Why is the private sector able to provide fire insurance against our houses burning down, but can't provide it against disability insurance? Well, I think fire insurance, one is the verifiability. It's pretty verifiable whether or not people have got that sort of need. But I think more important than that is it's a one-off. Yeah. It's a one-off event. It's not like this is an event which is going to go on for the rest of your life. It's a serious event, but it happens once, it can be measured once, and the private sector goes in. It's not that the private sector is making a commitment to keep on providing housing for that individual for the rest of their lives. They've got a kind of a contained commitment. So I think there's an element there about the kind of verifiability. There's an element about the transitory nature of it. And I think where we can see that very much is there isn't private insurance against disability shocks. There is that insurance, but it's basically time limited. So if you wanted insurance, which was I have a health shock, which means I cannot pay my mortgage for the next year, or I cannot earn for the next year, you can take that out. Particularly if you're higher educated, it's reason that it's not super expensive to take it out. But that private insurance, it doesn't insure you against the costs such as cancer or long-term disabilities, which mean you're not going to be able to work again. And so I think this, again, when we're thinking about these health shocks, the key thing that means the government's more important here is exactly because of the persistence and the seriousness of the nature of the shocks, which means that the private sector doesn't get involved. Could we incentivize them? Well, again, we're willing to incentivize them to do that if we're willing to pay them. But that doesn't solve the problem. I mean, the fundamental information problem lies with the government or the private sector about how do you verify people's health and how do you incentivize people to look after themselves and to keep working when they can.
Great. Okay, the last question is really about okay, one way of interpreting it, I think, is about, is there any difference, you think, in terms of where actually the government has played a role or other firms have played a role, I guess, in that health shock arising, in terms of maybe the types of support or anyway types of like research in this area? So the question is about military veterans specifically, being one area where disabilities claims have risen. But I guess I was also thinking about, in many areas of the public sector, we might think about exposure to risks which cause health shocks as being greater. And do you know of any particular work in that area, or is there any like kind of particular, I guess, angles to that issue that you think are relevant for economists?
So I think it is important to kind of make the following distinction. There are health shocks that arise in the course of one's job. And you see that particularly for veterans and people in the armed forces. But there are a lot of professions where there are health risks associated with the job that someone's doing. And those kind of work-related health shocks are typically compensated in a different way and insured in a different way. And the firms are involved in that context. I think there's a broader issue about did the government cause more health-related problems by its response to COVID, for instance, and did that kind of exacerbate things? I guess what I'd like to kind of make just to kind of on this is really about what role can firms themselves play in terms of trying to mitigate the extent of people on disability insurance. And one of the kind of examples of this comes from the Netherlands, where firms where their workers go on to disability insurance, not because of a firm-related shock, but because they have a health-related shock. If they go on to disability insurance because they've had a health shock, like they've got whether it's stress or cancer or what it is, those sort of shocks are then partially paid for by the firm. Oh. So there's experience rating where the more workers you've had that have gone on to these benefits, the more you have to pay. Now, what that's done is that's been a big contributor to firms actually providing more support at work for workers who are actually in need of help. And I think that's where, if one of the lessons I've kind of learned is a really important aspect of disability insurance is trying to keep people attached to the workforce. Because once people get detached, then they end up, their skills depreciate and they end up becoming more and more, less and less employable. So the more attached they remain, the better. Now, that's really about incentivizing the firms to adapt the workplace and to put in place things like mental health support, physical supports for individuals who actually need that sort of help. And that adaptation can actually help to mitigate the kind of other costs. And I think what's happened in the Netherlands, where, okay, you can put in place the adaptation, but you're really incentivized to do it, because if you've not put in place the adaptation and then people then leave, you're going to pay the price. Yeah. So I think that's where the role of firms is actually pretty important here, or can be important.
That's brilliant. Well, we are out of time, but thank you so much, Hamish, for the great talk and Q&A, and thank you so much for everyone for joining and the wonderful questions. There'll be future What Economists Really Do being advertised via the kind of department Twitter and LinkedIn, so keep an eye out. Thank you.
Thank you.